For 6 straight years, Fortune called Enron the most innovative company in America. The innovation was fraud. The story starts in 1985, when 2 boring pipeline companies decided to merge. Houston Natural Gas joined into North in a roughly $2.3 billion deal. A year later, it was renamed Enron, run by Chairman Kenneth Lay. For a while, it simply moved natural gas through steel pipes buried in the ground. Then the government deregulated gas, and the pipelines lost their monopoly. A former McKinsey consultant named Jeffrey Skilling had a radical idea: stop selling just gas and start trading contracts on its future price. Enron became a Wall Street trading floor disguised as an energy firm. Skilling championed an accounting method called mark-to-market, which let Enron book years of future profit the day a deal was signed. If a deal soured later, the imaginary profit had already been counted. To hide the mounting debt, CFO Andrew Fastow built secret partnerships, naming one LJM for his wife Leah and his 2 sons. These shell entities swallowed Enron's losses and kept them off the books. On paper, Enron looked flawless, and the stock peaked above $90 in 2000. Behind the scenes, its traders were gaming California's power market with schemes nicknamed Death Star and Get Shorty to spike prices. They even joked on tape about taking money from a grandmother during the blackouts. In March 2001, a Fortune reporter dared to ask how Enron actually made money, and the question would soon unravel the whole company. In August, Skilling abruptly quit, citing personal reasons. That same month, executive Sharon Watkins warned Lay the company might implode in a wave of accounting scandals. In September, Lay still urged employees to keep buying the stock as a bargain. On October 16th, Enron reported a sudden $618 million quarterly loss, and days later the SEC opened an inquiry into the partnerships. On November 8th, Enron admitted it had overstated profits going back to 1997. Rival Dynegy offered a rescue merger, then read the books and fled. On November 28th, the credit agencies cut Enron's debt to junk. On December 2, 2001, Enron filed the largest bankruptcy in U.S. history. More than $63 billion in assets evaporated, and the stock became nearly worthless. Workers had been locked out of their 401ks as the shares collapsed. Thousands lost their jobs and their retirement savings at once. Arthur Andersen, Enron's auditor, was convicted of shredding documents. The 89-year-old accounting giant collapsed, taking thousands of jobs with it. Fastow got 6 years, Skilling got more than 24. Kenneth Lay was convicted, then died of a heart attack before sentencing. Congress passed the Sarbanes-Oxley Act to make sure it never happened again. The smartest guys in the room built a $63 billion lie. Follow boom and bust for the true stories behind the money.